Hi, everyone. Welcome to the Guiding You Forward podcast. Today, we're talking all about mortgages. And on the show today, we have Nanette Graviet. Hi, Nanette.
Hi, Kristalina.
What are some of the most common loan types? Again, we talked about that first-time homebuyer one already, but let's say I'm not a first-time homebuyer.
There's so many loan options.
What do I do? Okay.
Yeah, there's still so many choices that you might have. So there's a bank of loans for first-time home buyers, but there's a lot of loans if you have a down payment. There's conventional loans. Conventional loans, you can get financing up to 97%. So even though we're saying, yeah, you can get 100%, you can also get up to 97%, and you don't have to be a first-time home buyer. Now, if you are not putting down 20% on just a standard conventional loan, you're going to deal with what's called mortgage insurance. A lot of people don't like to pay mortgage insurance. One of the nice things about conventional mortgage insurance is that at some point it will come off your loan, so it's not on there forever. So there's some trade-offs, but there's conventional loans, there's FHA loans. Those are government-backed loans that have a smaller down payment, just 3.5%. There's VA loans, and those are designed specifically for veterans. Those are really cool loans. They do offer up to 100% financing, no mortgage insurance. So they're really, really cool loans for our veterans, and I'm really glad that program exists. We also have what's called USDA loans, and those are for more rural areas. So usually those are income-based, so we're looking for something that's in more of a rural setting where maybe the area median income is a little bit lower. So that's designed there. We also have construction loans. Those are really exciting because maybe you go out shopping and you're like, oh, I like this house, but I like this house, but maybe you're going to look for something and you're going to find the plans that you fall in love with and you want to build your home. And so we have loans to make that happen.
Awesome.
Beyond that, we have a whole bunch of portfolio loans, and those are loans that are very unique to Mountain America. Those are offered by us, and they're just very unique programs that we offer that don't necessarily exist elsewhere.
Awesome. So pretty much there's something
options
for everyone.
Yes.
Okay, awesome. Good to know. Good to know. So along with all these different types of mortgages, and we're seeing record lows for rates, how can I save money on my mortgage? Like, what advice do you have for either those of us, maybe we're just getting into a mortgage for the first time, or I've been in my house now for 8 years.
Yeah.
How do I get rid of that payment?
I know it seems daunting when you think 30 years. Sometimes it's hard to think down the road 5 years, let alone 30 years. You know, where am I going to be?
Yeah.
Most people are opting for a fixed rate mortgage. A fixed rate mortgage is going to give you the same rate over the life of the loan, whether you choose, say, a 30-year mortgage or a 15-year mortgage. Your rate, your interest rate, is never going to change over that time frame, unless you refinance or do something, sell your house. Obviously, that goes away. The other option is an adjustable rate. And with an adjustable rate, you're going to have a fixed period at the beginning, and there's a variety of different ARM programs, adjustable rate mortgage. Variety of ARM programs, and you're going to have some sort of a fixed period where your rate is static and it's not going to change. And then after that, you're going to go into adjustments. And typically ARMs adjust. There's lots of different rules, and so you'd want to read and understand the ARM that you're looking at. But normally they could readjust every year. And that depends on what the market's doing. So normally an ARM has a ceiling and it has a floor. So there's a point to where it's never going to drop below something. It's also never going to go over something. Some people don't like that uncertainty. If you're not going to keep your home for a very long time, if you know I'm really only going to stay in the home 3 to 4 years, an ARM, say a 5-year ARM, it's a pretty safe bet because you know you're going to have that fixed period for that period of time. Just as your rate could go up, it can also come back down. So it really depends a little bit. When rates go up, some people look at adjustable rate mortgages a little more closely because it helps give them a slightly lower interest rate. We're not seeing quite as much of that right now. The rates are pretty close, so why not just stick with a fixed rate?
Sure. Okay. So, but potentially if mortgage rates go up, an ARM could be, I mean, your mortgage payment's going up.
your mortgage payment could go up.
Okay.
Yeah. But it doesn't necessarily always mean that it's going to just go right up to the ceiling.
Okay.
There's levers in place to hold that so it would gradually increase and not go more than a certain amount every year. So if rates shot up and they were, say, 18% next year, maybe your ARM, if you're in adjustments, would only go up 2 points.
Okay.
2 percentage points. So it's not going to be hugely drastic typically on those change dates right there.
Okay.
So I know we talked about, okay, that's the interest rate. Another thing a lot of people hear when they are talking about rates is APR, your annual percentage rate. And they think, what is that?
Yeah. APY, APR, all these ARMs, ARMs.
There's a
lot
lot
of acronyms.
Yes. It's almost like you need a dictionary, a mortgage dictionary to be able to speak mortgage. The APR, your annual percentage rate, is a calculation that is very useful if you're going to shop and compare lenders, because everybody is going to have some closing costs, but they might look a little different. They might be titled something a little bit different, but there, per regulation, are fees that are required to go into a calculation to figure what that APR. So if you were to get 3 different estimates, instead of looking just at the interest rate, you would look at that APR to see how the fees are impacting the rate.
Okay.
So you might have somebody over here who has a really low interest rate, but their fees are really high. And then you have somebody over here who has kind of a moderately, kind of a medium interest rate, but fees are kind of right in the middle. And their APR could be almost the same. So, because you're going to, if you pay more fees, you can usually get a lower interest rate because you can buy down that rate.
Okay. Okay. So that's something to keep in mind. Good grief. There's a lot to know. This is why we need a mortgage specialist.
Yes.
You guys. Oh my gosh. Okay. So let's say I've already got my rate. I've already got my mortgage. I've been in my house for 8 years. How do I save money on this mortgage?
Like, how do you pay it off?
Yeah. I mean, besides just making payments, can I pay it off faster?
Absolutely.
I mean, obviously, maybe refinancing. I don't know. What are your
So there are some ways to pay off your mortgage faster.
Okay.
So making some extra principal payments, you can do that at any time. You can pay extra towards the principal. Mortgages work on a compounding interest basis. So the quicker you can get that principal amount down, the less interest you're going to pay over the life of the loan. One handy trick is if you could pay even one extra principal and interest payment per year, you can knock about 7 years off a traditional 30-year mortgage. So right there, you're 8 years in. If you could pay one extra principal and interest payment, and I'm not talking about that amount that goes towards paying your taxes and insurance. I'm just saying the principal and interest. And when you have your mortgage statement, it's broken down really nice.
Yeah.
So you can see exactly what those are. If you just take that amount and at least pay it once a year, an extra principal payment, you can knock some serious time off your loan and save quite a bit in
thousands
interest.
of dollars.
Thousands of dollars.
Okay.
Yes.
Awesome. All right. So no more eating out. No, I'm kidding. Right now we're probably not eating out too much, but yeah, save that. That's really, really good advice.
There's lots of little things that you can do. And maybe you can't make a full extra payment per year. Could you make half a payment extra per year? Every little bit that you put down on that is going to help you pay off the mortgage faster. Or if you decide to sell at some point, you're building that equity. You're reducing the debt on the home.
Okay. Awesome. I love that. That's exciting. All right. I know what I'm going to do this month.
Pay a little more.
Pay a little more. Let's do it. Okay. That's incredible. I don't know if that's widely announced.
Yeah. It's so fun when you start getting that mortgage statement and you see your payment going down more and more and more. And the more that you can put towards the principal, the faster you're going to see that come down.
Okay.